As it turns out, we did have the unexpected result, and markets did react rather violently.
So markets are constantly changing. In your opinion, have your investors changed their investor approach in recent years?
Well, I think investors' expectations and their approach has changed over the years. There's nothing like a financial crisis to sharpen one's wits and take more of an interest in their affairs. Also, the advance we've seen in technology has made investors' expectations change. So they are now expecting all the information that is available at their fingertips. So there's a lot more dialogue one has now with the clients. At the same time, they are fully aware, as a result of all that we now live in a world of negative or very low interest rates. So they do understand that the return environment that we've had pre the crises that we had is obviously a very different one now.
And that's really interesting. So you mentioned interest rates, but there's also been the financial crisis, and that's been a very volatile few years for markets, and it's been very uncertain. So what do your clients actually want?
So our clients are really looking to understand and feel confident that we have a very solid investment process, which means that they are confident that we're doing the right thing for them, irrespective of whether the markets are moving up or down, because one needs to have the confidence to sit through these rather volatile times. On the other hand, they need to be reassured that we have the capacity to do what it takes for them, and obviously to give them a fantastic service, because, as I said earlier, their expectations on service and dialogue have increased quite a bit over time.
So you've mentioned the volatile markets there. So what is FFG's views and outlooks for investors' approach?
So we started the year with a very defensive stance, as we saw the markets going down early in January, which was on the back of the central people losing confidence or having doubts about the central bank's ability to prop up the system or to keep us out of worse times than we're in at the moment. Brexit was clearly an unexpected outcome of a rather important factor for not only the UK economy, but in fact also the global economy. We had decided to hedge our UK and European equity risk 2 weeks prior to Brexit, as we felt that the opportunity cost of being invested in the European equity markets was rather low relative to the large reaction that was inevitably going to happen if we were to have this unexpected result. As it turns out, we did have the unexpected result, and markets did react rather violently. So we've maintained our defensive stance for the moment going forward, which we think is a prudent thing to do right now. But we're looking for moments of or signs of economic growth, which we're starting to see certainly in the US. So we may well increase our equity exposure going forward as these signs become more and more credible. We do think that the emerging markets could also be a pocket of opportunity as US interests stay low for a little bit longer. That will certainly help them, and they are historically at fairly low levels. As far as the fixed income area is concerned, we are looking more for the high yield or loans part of the market rather than the government debt, which we've not been investing in for a long time, because we feel negative interest rates are not attractive, obviously, but also even a bit further out, only earning 1 or 2%, lending your money to the government for 5 years is not really an attractive proposition.
Fantastic. Well, thank you so much for coming in today and sharing your insights.
You're very welcome.
That's all from us here in the Dukascopy Geneva studios, but if you did like this interview, do like and comment on dukascopy.tv.